Welcome to Reconstruction. Finance. Following the Great Depression of 1929, economists realized that something needed to change. Through public pressure by Union socialists, communists, and anarchists, the Roosevelt government was forced to implement several types of regulation and government assistance programs that would help the economy get out of the Depression. Franklin Roosevelt initiated the 3 R's: relief, recovery, and reform, through the Banking Act of 1933. This act saw the creation of the SEC, which is the Security Exchange Council, which monitored the financial markets against inside trading and fraud. The creation of the Securities Act, which regulated the offer and sale of securities. This created transparency in financial statements, so investors could be better informed on decisions about their investment opportunities. And it also made laws against misrepresentation or fraudulent activities in the market. The creation of the FDIC, the Federal Deposit Insurance Corporation, which was designed to insure depositors' money in savings banks. It also saw the creation of the Glass-Steagall Act, which separated commercial from investment banking. This protected public depositors from their money being used to supplement risky investments by the bankers. And it also saw the creation of Regulation Q, which outlawed the payment of interest on checking accounts and placed ceilings on the amount of interest that could be paid on other deposits. As economist Gerald Epstein notes of this era, quote, "During this period, most of the activity of banks, commercial banks particularly, was in terms of taking in deposits, making individual loans, business loans, mortgage, real estate loans. Many people call this age of boring banking. It was also called the age of 363 banking. Bankers paid 3% of interest, lent out 6%, and got to the golf course by 3 in the afternoon." This era of boring banking didn't last long. It was around 1967 the first consumer credit card, referred to as the Everything Card, provided by the First National City Bank, known today as Citibank, was issued for consumers. This is important to note. Before this time, credit cards were only seen as a corporate product. With the introduction of credit cards to the public, the issuance of debt began to grow. It was also shortly around this time that the median salaries would peak and begin to stagnate, making many of those who used to depend on income for a certain standard of living rely more heavily on credit. In 1974, Walter Wriston, CEO of Citigroup, brought CDS, credit default swaps, to the market. CDSs shifted the risk of normal buyer and seller of a bond, loan, or security product by introducing a third party to the group. If a buyer of a loan receives a full payment from the seller, the buyer will share the interest gained from this product with an insurance group that they go through. If the seller cannot fulfill their end of the bargain and pay the loan with full interest, then the insurance company will provide the full amount to the buyer. This was a form of spreading the risk. This also began the growth of risky financial products. In 1974, Wriston also convinced the Secretary of Treasury George Shultz to let commercial banks to recycle petrodollars to other countries. The exchange of petrodollars was usually left to the IMF, the International Monetary Fund, and the World Bank. This expanded the use of loans to other countries. As a foreign policy article wrote, quote, "Many have held the recycling of petrodollars the lending of hundreds of billion dollars from wealthier oil exporting countries to Eastern Europe and less developed countries by U.S. and other private commercial banks as the economic success story of the 1970s. The ease with which these countries were able to finance chronic and growing balance of payment deficits, rather than having to reduce imports and slow growth, created the illusion that the lasting economic costs attended quintupling of oil prices in 1973, more than doubling in 1979. In 1980, Regulation Q was weakened when President Carter began deregulation of interest rates through the passing of the Depository Institution Deregulation and Monetary Act of 1980. This allowed free rein of banks to raise the interest rates on consumers. Following these acts, as economist Gerald Epstein notes on this era, quote, "Relatively unregulated banks could pay depositors higher interest rates, could charge higher interest rates on their loans, could engage in new kinds of financial innovations, such as secularization, which is placing a bunch of loans into a bundle, such as an asset-backed security or mortgage-backed security, selling these things off. Boring banking could no longer compete, so instead of engaging into one-to-one lending, they started engaging in more activities with the capital markets, bundling up or securitizing loans, selling them off, using derivatives to hedge risks but also make bets. They kind of became like hedge funds in the sense of doing a lot of trading, buying and selling a lot of derivatives, engaging with the securities and the capital markets, but they still had the government guarantee like they were banks. The Economic Recovery Act of 1981 lowered capital gains tax, which is a tax on money earned through trading. There was also a modest increase through the 80s to raise it back up to 28% following the recessions of the initial 1981 Act. Since the 1990s, the tax has stayed around 15%, far below the average taxes on workers' salaries. In 1982, the SEC Rule 10b-18 allowed companies to receive a safe harbor from market manipulation liability on stock buybacks. In other words, they could buy back stock without the harassment of manipulating the market. A 2004 revision did make companies disclose when they bought back their own stock at the end of each quarter. Yet, as economist William Lasnik reported to The Intercept in 2015, investigations into corporate buybacks are exceedingly rare. The rule was licensed to manipulate the market. End quote. In 1991, we saw the creation of the Commodity Index Fund by Goldman Sachs. This allowed raw materials to become securities that could be bought and sold to investors. As a 2008 study on the rise of food prices commented, quote, "The surge of investment into future commodities market for non-traditional sources may have short-term price effects, but relative to the 10-year outlook period, these may prove temporary given the adjustments in market and participants' behavior. Funds can move more rapidly in and out of commodity markets as profits opportunities." In 1999, we saw the last remnants of the Glass-Steagall Act dismantled through the Graham-Bailey Act, which broke down the last barrier that stood between investment bankers using public money from commercial banks as collateral. 2000 saw the beginning deregulation of the commodities market. Since the Great Recession, 2008 investors had been moving their betting to safe bets, which are bets on raw materials raising their prices and making those prices more unstable for regular consumers. As a Harvard report following the effects of the financial collapse noted, quote, "By the summer of 2008, the prices of oil, agricultural products, and other commodities, which are generally denominated in US dollars, soared almost inverse proportion to any decline in the dollar." So in other words, they increased while the dollar's value decreased. And this became a new business model for finance and business. As Foroohar in her book Makers and Takers talks about how companies have relied more on finance than selling their own products, using the example of automakers making more money off finance than selling cars. Energy companies boost their profits speculating in oil futures instead of investing their money into renewable energy, and airlines make more money hedging on the oil prices than selling airfare. The focus on stockholders instead of customers and the public at large has been in practice since 1919, following the Supreme Court case of Dodge versus Ford Motor, which established the idea that, quote, "A business corporation is organized and concerned primarily for the profit of stockholders." A Stanford University research report showed that tech firms scaled back innovation by 40% after they went public. Their focus shifted from its future products to its stockholders. And this worsens every time the Fed lowers the interest rates each time a bubble bursts, because it adds fuel to the fire. What happens when you give a bunch of financiers easy money and zero interest rate is that they go out and try to make more money. That's what they are wired to do. As Rakesh Sharma, head of emerging market for Morgan Stanley, commented, "Easy money monetary policy is the best reward for Wall Street. After all, it's mainly the rich who benefit from a rising stock market." Educating people on the risk of a deregulated financial system seems to be missing from our business schools. As we're seeing a rise in MBA programs, we're also seeing a continued push for this risky behavior. Considering only half of MBA programs require an ethics course and only 6% have sustainability in their core curriculum, while at the same time there's a large body of research showing that sustainability actually provides higher long-term performance for businesses. A McKinsey data report showed that between 70 to 90% of real value of any corporation tends to be tied to revenues 3 years or more out. In other words, companies should be looking at the long term if they want to have a long future, but MBA programs are not teaching this to students. Finance and the School of Economics have flooded our society with misinformation and ideological falsehoods so they could continue to make money while relying on the public for when things go sour. And when this is brought to their attention, they deny it. They suggest it's a complicated issue, which it is, and that's the problem. For example, a derivative can be such a complex product to explain. As Investopia explains it, it's a security with a price that is dependent upon or derived from one or more underlying assets. The derivative itself is a contract between two or more parties based upon the asset or assets. Its value is determined by fluctuations in the underlying asset. The most common underlying asset includes stock, bonds, commodities, currencies, interest rates, and market indexes. Did you get that? But that's the point. It's complicated for the sake of keeping us out of the game and forcing a smaller group with all the power calling the shots. And while that jargon might be difficult to get your head around, the purpose and intent of it isn't, and that's something everyone can understand. So where do we go from here? The idea of discussing finance, economics, or questioning the idea of capitalism instantly becomes a challenge. Most books that discuss these subjects have to openly defend capitalism as if it were blasphemy to question it. And while those economists who are more inclined to Keynesian beliefs are still pushed out of the mainstream conversation, Marxist or socialist writers are near non-existent except for a few independent publishers. Even Thomas Piketty, the author who wrote Capital in the 21st Century, who is not a socialist, had to constantly remind readers he didn't believe in Marxist ideas. This kind of treatment of other economic ideas in politics really holds us back from allowing us to come up with new solutions. Whether we look to implementing new regulations or nationalizing institutions, we should be open to the variety of economic thoughts that exist. They exist and are studied for a reason. Practicing only ideological economics is what got us into this mess. The market knows best blinded Alan Greenspan, Ben Bernanke, and Henry Paulson. These people ignored those who saw the rise of risky trading, growing private debt, and tried to warn the public. Yet Greenspan, Bernanke, and Timothy Geithner get book deals, continuing to spread their ideological nonsense, while those people pointing out all the warning signs were shoved into the back to stay quiet. Finance is not an easy subject to break down, but it has to be understood as a systemic problem. As economist Hyman Minsky argued, quote, "The fundamental instability of capitalist economy is upward. Tendency to transform doing well into a speculative investment boom is the basic instability in a capitalist economy." And there are proposals out there to make finance more fair, as well as ideas to make finance more democratic. A December Pew Research report showed that more people were in favor of regulating corporations, seeing that it did more harm when they weren't regulated as opposed to when they are regulated. Thus, we're beginning to see more of a demand for new regulations. Most economists that are in favor of reining in finance speak of raising capital gains tax. This idea corresponds with the Robin Hood tax group, which was an offshoot from Occupy Wall Street. The taxing of financial transactions or increasing the capital gains tax has also been proposed by popular senators like Elizabeth Warren and Bernie Sanders. As recent as April 2017, there has been reports of Senator Elizabeth Warren and John McCain trying to pass a new version of the Glass-Steagall Act that would separate investment banking from commercial banking. Rana Foroohar, in her book Makers and Takers, suggests that finance should focus more on equity and less on debt. This idea is further examined by Steve Keen in his book Can We Avoid Another Crisis? Another simple, although difficult solution to implement is by prohibiting reckless behavior from investors and finance community, holding them accountable, whether with jail time or by breaking up the monopoly of banks. The more radical but real solutions of nationalizing banks has also been growing. There are many solutions out there, we just have to push our politicians and leaders and businesses to do better. At the end of the day, finance should work for the public. As the British Labour declared in June 1944, quote, "Finance must be the servant and intelligent servant of the community and productive industry, not their stupid master." Feel free to subscribe. Also feel free to check out the channel, my other videos that I have up. I will definitely have more coming soon, more periodically as well. Feel free to like and follow on any of the social media platforms, and thanks for watching, and welcome to Reconstruction.